Ladies and gentlemen, good afternoon. Welcome to this Shywin financial reporting webinar from wherever you are. I am Bessie Zhang, an audit partner in the Brisbane office, and I will be moderating today's session and giving you an update on some ASIC matters. It is great to have so many of you in. Our presenters are from across the Shywin national practice. Renee Muller will present on the removal of special purpose reporting. Tom Malaki will be talking about leases. Jimmy Cao will give us an insight on other new accounting standards. And finally, Callum Murray will discuss the expected financial reporting issues resulting from COVID-19. Before we start, I would like to recommend that you use the full screen mode to achieve the best webinar experience. You can also find the Q&A button at the bottom of your screen. Please send us questions as we go. We will monitor these and answer any that we can during the presentations. Some we will save for the Q&A at the end of the session, but for more bespoke questions, we may need to connect with you afterwards. Before we kick off, we are running 2 live polls today. They should appear on your screen now. Please take a few minutes to answer them. They'll be there as we go, but once you answer the questions, they will disappear, and we will share the results with you later in the session. While you answer the questions, let me start with an ASIC update before handing over to the rest of my team. There have been 2 announcements from ASIC to extend the financial reporting deadlines for 1 month. The first one is for unlisted entities only, with balance dates from 31st of December 2019 to 31st of March 2020. So mainly December and March year-end financial reports. The second announcement extended to listed entities, with mainly March and June 2020 year-end financial reports. While for the unlisted entities, the extension covers December 19 and March and June 2020 year-end financial reports. Therefore, the financial reporting deadline for listed entities, unlisted disclosing entities, or unlisted registered scheme with the balance dates fees in the period on the table are extended from 3 to 4 months. Half-year financial reports for these entities are extended from 75 days to 75 days plus a month. All the other unlisted entities is extended from 4 to 5 months, including public and PTY companies that are not disclosing entities. There are some general conditions for this extension. Where possible, entities should continue to launch with the statutory deadlines having regards to the information needs of the shareholders, creditors, and other users of the financial reports, or to meet borrowing covenants or other obligations. And another one is very important, which is ASX listed entities will need to launch Appendix 4E by the due date, which is 2 months. That means 31st August 2020 for June year-end. If the entity does not have audit accounts to append to a 4E, it will need to launch an audit accounts with 4E. I hope we are clear about the deadlines now. Next, I'd like to run through the audit inspection findings for the 12-month period to 30th June 2019. ASIC is performing audit quality review on a broader and more intensive approach. Not only listed companies have been picked up for review, and from the detailed report, we can see that they checked the audit files to an intensively detailed level. Then they will ask, why not litigate against the firm? I hope this could give you some hints about the pressures that the audit partners like myself bear when we sign off your accounts. ASIC also reiterated that the directors are primarily responsible for the quality of the financial report. So we auditors are helping to enhance the quality of your financial report. Please be continuously supportive as you have always been. The largest numbers of the diverse findings were in the audit of asset values, particularly impairment of non-financial assets. While the findings of ASIC's review of financial reports of 2019 is yet to be available, the improvement areas to the audit firms are really similar to the previous financial report review findings. Most points involve significant management estimate. For these areas, it's management and directors' responsibility to form your estimate based on the reliable information and reasonable measures. Then the auditors audit the supporting documents provided by management in accordance with auditing standards. Today, I'd like to talk about impairment of non-financial assets in a little bit more detail from financial reporting perspective. Impairment testing of non-financial assets is a complicated procedure. Let's go through the outline and recap some key points. The first step, as you know, is to determine when to test the impairment test, when to test for impairment. There are indicator-based impairment testing and mandatory impairment testing required when indicator exists or upon each reporting, financial reporting. That including a CGU or a group of CGUs to which goodwill has been allocated, intangible assets not yet available for use, and intangible assets with indefinite useful lives. And second step, identify level at which assets are tested for impairment, which includes individual assets or CGU, cash generating units. But how to determine your CGUs? Just remember, is the smallest group of assets that generates cash inflows. So inflows is more important. From continuing use that and they're largely independent of the cash inflows of other assets or groups. So the definition doesn't allow netting of impairment by determining a larger group of assets for impairment testing purpose. Consider how to test corporate assets and goodwill also fits in this step. And then the next step, step 3, determine recoverable amount. We know that recoverable amount is the higher of fair value less cost of disposal or value in use. The difference between these two is how to realize the value in the value of your assets by selling it or using it, whichever gives you the highest present value. There is a common misunderstanding that the cash flow model approach is to calculate value in use. Not necessarily. Fair value can be estimated by using a cash flow model as well. But there are many differences between a value in use cash flow model, which involves more internal considerations, and fair value cash flow model, which considers internal but also benchmark to the external situations and expectations. The fourth step, determine carrying amount of the CGU, which is the net book value of the non-financial assets, or sometimes the financing approach can be used, which is represented by the capital or long-term loans to support the CGU's operation. Last step, measure and recognize the impairment losses. That's about the outline of impairment testing. ASIC challenged the auditors on every single definition and step. If you're interested, you can read ASIC's report 648 for details. One of ASIC's criticism to the auditors is that auditors did not obtain sufficient evidence to support the reasonableness or challenge assumptions and forecasts used by management. I would also like to mention about using the work of experts. The auditing standards require that auditors should use their own experts where members of the audit team has insufficient knowledge or skills or experience. As especially emphasized, the auditors use their own experts and specialists, particularly for impairment assessment of mining assets. I know our firm have many mining clients, and also when auditing tax balances. I hope my sharing is insightful and maybe interesting to you. Now, let me hand over to Mr. Tom Malaki.
Thank you, Bessie, for those insights. Good afternoon, everybody. I will be taking you through AASB 16 leases today. I'm going to touch on what the definition of a lease is, and I'm going to give you some tips on how you can ensure you identify all those leases and capture them for accounting purposes. Take a look at some judgment areas around discount rate, lease term, and so on. And I'm also going to take a look at modifications, which is particularly relevant in a COVID-19 environment. So as most of you will have been quite busy at the moment, collating all the data, calculating your balances for initial recognition, for those of you who have sought rent reliefs and have gained rent concessions from your landlord or from your lessor, you now need to account for modifications. So it's a bit of a double whammy this year, but there is a practical expedient which I'll go through later on in the session. In terms of the criteria for determining whether you've got a lease, well, do you have an identified asset? Typically, that's a pretty straightforward question to answer. You'll have leased a floor of a building. You'll have an item of plant or equipment. There can be instances where you have got a right to use a portion of a capacity of an asset. So think, pipelines, fiber optic cables, and so on. There are some criteria then in the standard around ensuring that they're physically distinct, such that you'll have the identified asset. Can the landlord or the lessor, can they swap in and out the asset? If they can, well, then you don't meet the definition. Do you obtain substantially all the benefits from use of the asset? Typically, yes. There can be some rare scenarios where you'd share the asset, but I haven't come across too many of those in practice. And finally, do you direct the use of the asset? And you'll determine whether that's the case by answering questions around how the asset is used and for what purpose. Now, where the supplier might have involvement in those type of decisions, you might need to look a little bit closer at the arrangement. If the use of the asset is predetermined, again, you'll need to take look a bit closer. But in general, those are the three criteria, and if you satisfy those, you have a lease. As an auditor, I'm always concerned with ensuring completeness of my population, ensuring that all those leases are captured. So I'll start off, I'll take a look at your lease register and the process you've gone through to capture all those leases. If you're still going through that process at the moment, my tips to you would be take a look at your general ledger. If there's any recurring expenses or payments that you see going through there, it can be indicative of a lease. Take a look at last year's lease commitments note. It's typically an afterthought in the preparation of the financials, but it is a good place to start because any leases reflected in there, it's a good chance they'll need to be picked up this year as part of your AASB 6 leasing accounting. Talk to your operational staff. Understand what kind of assets you're using in the business and what kind of arrangement you have in place with the suppliers of those assets, and also consider whether you've got embedded leases. So that's in scenarios where you've got service agreements and arrangements where you use some assets. So think in terms of IT packages. You've got software, hardware, licensing, and so on. Well, that hardware, if you go through the steps, you might end up in a lease, and you might need to book that asset as an ROU. In terms of the lease term, we'll take a little bit of a look at the non-cancelable lease period. I'll also look at some options in there and that this reasonably certain criteria that you need to assess when you're determining the term. This is an important area again. Auditors, again, we're interested in ensuring that you capture all the leases and that your lease term is captured properly, because if the term is incorrect, well, then the liability in your balance sheet will be incorrect. So in terms of some of those concepts, if the lessee and the lessor, if they've got the right to terminate the arrangement with no significant penalty, well, then you wouldn't recognize the term beyond that point. So if you take an example, both lessee and lessor have the right to terminate after 1 year without a significant penalty, well, then your lease term is 1 year. Now, I have had some clients who have looked at this clause and thought, well, if we put this clause in our leases, then we won't have to, abide by or comply with 16. However, that insignificant penalty criteria, it's very important, because even though that clause is in there, you may not have any commercial or practical reason for not exercising that option. So bear that in mind if you think this clause might be able to get you out of lease accounting. In terms of options to renew, options to terminate, if the lessor has those options, well, then you need to look at the likelihood. And in the next slide, I'll talk about how you determine the likelihood that those will be exercised. And finally, if the lessor has the right to terminate the lease, well, then that's the non-cancelable period. You would not book a term beyond that point. So, for example, if you've got a lease that's a 5+5 year lease, and you've booked a lease term of 5 years, but if the lessor has the option to terminate after 2, your lease term is 2 years. In terms of the facts and circumstances that you take into account to determine whether you're reasonably certain to exercise those options, this slide is taken direct from the standard. It talks about concepts around, well, if you're currently earning a favorable rental compared to the market, that could be an indicator. If the significant cost not to renew, that's an indicator. In terms of the asset itself, the nature of the asset, whether it's in the location of the asset, if it's an isolated location, if there's no suitable alternatives, that would be indicative that you're going to renew or utilize those options. And finally, I'll just talk about the existence of significant leasehold improvements. I've had an example of this with a client recently. They've entered into a 5+5 lease arrangement. They've booked a 5-year term because, they'll want to keep their options open in terms of when they're 3-4 years into the lease, they'll consider whether to renew. Fine and fair enough, but then when we look at their fixed assets accounting, we see that they've spent significant money on a refurbishment that has a 10-year useful life. Well, in that scenario, that fact would indicate that your lease term is 10 years. So when you are preparing your position papers around lease term, just make sure you articulate the reasons why you've adopted the term you have, because the auditor will look pretty closely at this. In terms of the rate you apply, the discount rate to those future lease payments, typically you would apply the rate that's implicit in the lease, which is, for finance leases, that's typically was stated. For operating leases, it isn't. So the standard says you can use what's known as an incremental borrowing rate, which is a rate you would pay for a similar asset of a similar value for a similar term. So in my experience, this rate, it's built up along the lines of, you start off with your risk-free rate, which would reflect the economic environment in which you're in. You would then have a margin applied to that, which would be reflective of the leasee's credit rating. And then there would be a component which would relate to the security of the underlying asset. And when you put all those components together, you'll have your incremental borrowing rate. Again, this is an area that auditors will take a close look at. From a client's perspective, you probably want a higher rate, because when you discount it back to net present value, it'll be a lower liability. So the auditor will take a close look to make sure that they were comfortable with the components. In terms of the scenarios where you would revise the incremental borrowing rate, if you extend the lease term, so you're now reasonably certain you're going to exercise an option, the term is increased, you would change your incremental borrowing rate. Again, an option to buy the asset, or if the rentals are linked to a floating interest rate index, and that those floating interest rates change, you would have to change your discount rate. Bear in mind, where you've got CPI escalation clauses, which many leases do, on the annual anniversary of that lease, when you change the payments, you don't need to change the discount rate. So I've seen some clients make some errors in that regard. In terms of a portfolio approach, typically you have to apply a rate to each individual lease, but the standard does allow for the portfolio. So if you've got a portfolio of similar assets with similar terms, you can quantify one rate for those particular assets. So what I've seen in practice is clients will have leases that will fall into a bucket of 1 to 3 years, 3 to 7, 7 to 10, and they'll calculate a separate rate for all those buckets. So it does make it easier. In terms of your transitional method, modified retrospective 2 is by far the most popular. Under that method, you'll calculate what your opening lease liability is, and you'll recognize the right of use, the opening right of use, as equal to that lease liability. So you won't have any opening retained earnings adjustments to book. I have seen some clients, however, that have taken a look at modified retrospective 1, where you would have an opening retained earnings a difference, and they've had different reasons for doing that, potentially around EBITDA, trying to see what kind of impact it has going forward. But by and large, I think option 2 is the most popular, and it's definitely the easiest from an accounting perspective. In terms of modifications, now modifications arise where you've made changes, you've renegotiated terms which weren't in the original contract. So if you add additional space to your lease, if there's a decrease in office space, which I think might be what a lot of companies are doing post COVID with the success of the working from home arrangements, maybe the necessity for so much office space might not be there anymore. You can increase the lease term, but I think point number 4, decrease lease payments. Now, I think, typically in accordance with the standard, you'd have to recalculate your lease liability and adjust your ROU. Now, given that you've already gone through a whole load of work to calculate your initial balances on adoption, now you have to revisit and do this whole exercise again for your modifications. It's a lot of work and a lot of heartache. So the AASB, they've taken on board feedback. So they have come up with a rental, COVID-19 related rental concession arrangement, which is a practical experience for lessees. If you've negotiated a rental concession, if you've negotiated a waiver, you can recognize that as a variable lease payment, whereby you'll essentially book a credit to your income statement. If there's a deferral, you can just continue to reduce the lease payment as you go, and a combination of the two, well, then you'll either account for it as a waiver or a deferral. Note, it's not available to lessors. So the AASB said for the lessors out there, your systems and your processes should be able to handle lease modifications. Now the conditions, it's actually quite narrow conditions to qualify. You can't end up with a higher lease payment. The reduced payments have to apply to FY 2020 only, and you can't make any other changes to the lease. So if you think you've organised or you've negotiated a concession, you think, happy days, I'm going to have a credit to my income statement. Typically, landlords, they might want to change some other terms, so they might say add on a year or 2 onto the term. If they've changed other terms, well, then you won't qualify for this expedient. So look, that's been a real whistle stop tour through leases. If you have any issues or concerns, by all means, please reach out to Renee or myself or anybody in the team. We're very familiar with the concepts now. Thank you for listening. And I just remind you, if you haven't already answered the polling question, I know some of you might have joined a little bit late. There's polling questions around leasing, so please answer the question when you can. Thank you, and I will hand over to my colleague, Jimmy. Thank you.
Thank you, Tom. I'll take from here. In addition to the new leasing standard that come to effect for the first time for June year-end entities, there's a couple of other new standards that's worth noting. In addition, there is a standard that's going to be effective for December year-end entity. And I'm also going to briefly touch on what are the new standards for the not-for-profit entities and give you an update on other regulatory developments. So this is the list for the first time that's effective for June 2020 entities. There's a couple of notable ones. I'm going to go into a bit more in detail. So the first one is how do you account for uncertain tax positions? once the company submit their tax return to ATO, the ATO may just have a disagreement on certain expenses. What's the deductibility of those expenses? So depending on whether the ATO is likely to agree with the treatment, if it's probable that they are going to agree, they are going to allow the deductible of those expenses, your financial statement will then reflect what your tax return position. However, if the agreement is not likely, if it's not probable, what then the company need to do is to look what's going to be the most likely outcome. It can be 50% of the expense going to be allowed, then you're booking that 50%. Or you put a percentage as a weighted average outcome to derive expected value and book that into your book. So in addition to that, we're also looking into the changes to the long-term interest in associate and joint ventures. So an entity, if they have an investment in an associate and joint venture, in addition to the equity interest, you might also give them a loan to help the associate to operate. And the loan may not be repaid in the foreseeable future. So from the accounting standard perspective, this will constitute as a long-term investment. So the company is required to recognize the share of losses of the associate if the equity interest has reduced to zero, then what they need to do is actually absorb those losses in the equity loan. And on top of that, the new accounting standard require the company to look into expected credit loss under the requirement under AASB 9 to those equity loans first before they apply any equity accounting on those equity loans. So the takeaway point is it's going to be quite messy because you have two different accounting standards that's govern the same instrument. So additional work is definitely required if you have investment in the associate and joint venture. So we have talked about what are the standard first time effective for June 2020 entities. So there's two very important standard that's going to be effective for December year end. Just bear in mind if you are reporting an interim financial report, those standards should have already been effective. So let's look into the definition of a business. So the definition of a business has significantly changed as a result of this new accounting standard. So before I dive into the detail, what has changed, what's the new requirement, let's just take a step back. Why is this important? So when you're buying a company, you can buy as a business. Alternatively, it can just be assets and the liabilities. They are encapsulated in a company. So essentially you're buying assets and liability. So if you were to conclude this acquisition is a acquiring of assets, what you can do, you can capitalize your transaction costs or the lawyer's fee that you spend or the agent's fee that you pay to your investment bank. You are able to capitalize those expenses in your assets. On the other hand, if you conclude that's a business, so all those expenses will then need to be expensed into your P&L. So let's look into what's the new definition of a business. So a business needs to include an input, a substantive process to create an output. So let me just give you an example, very simple examples. If you are now buying a company who produce, let's say, surgical mask, and what you are buying in your purchase agreement, you're taking over the raw material, the plant and equipment, but you're not taking over any employee from the existing owners. So in that case, what's your input? Your input will be your raw material, your plant and equipment, and your output will be the surgical mask. But you can very easily to see you don't have a process, you don't have a substantive process to turn your input into output. So in that particular case, you are essentially buying the assets instead of a business. So just building on this example a little bit. Now, not only you're taking over the raw material, the plant equipment, you're also going to take over the established workforce. The workforce who know how to operate the machine, they know where to buy the raw material, they know when the machine breaks down, how to troubleshoot it. In that case, you have the final missing piece of being a business. That's a substantive process. In that particular situations, you are acquiring a business. So the new accounting standard has provided a lot of additional guidance in terms of if you're having an input, have a process without the presence of output, what do you do with that? And if you're familiar with the old standard, they have narrowed the definition of an output. So in addition to the new definition of a business, the new accounting standard also introduced an optional concentration test. What does it mean is when you look at the total assets that you have acquired, if you can attribute to most of the assets to one particular asset or a group of assets that share the same economic characteristic or the risk, you can then straight away account for this as an asset requisition. So the takeaway point is if the company historically have M&A activities and is looking into buying some other companies, you will want to look into this particular changes to the accounting standard in details because it will likely affect your goodwill, contingent considerations, accounting for transaction costs, and deferred tax accounting. So now we look at the definition of business. The accounting standard also changed what is material. So what's the most important things change in this aspect is it's actually introduced the concept of obscuring. If you look at this track changes version, you will notice previously what is defined as material is if the information is omitting and misstating, it will influence the user of the financial statement. And in the revised standard, they also say if the information being obscured and if that influence the user of the financial statement, you will then see this as a material informations. And also, it's not just any users because you can be from A to Z, everyone can be your user. The new definitions actually specifically say it's the primary user of the financial statement. So the takeaway from this is now when the directors and the managements looking at the financial statement, they are required to take a holistic view, what is material to the users, rather than using a checklist approach, putting in as much as information as possible. So that's bear in mind when you're preparing for the next report. There is some new standards will be effective beyond 2020. Renee is going to bring us through on the most important one in relation to the removal of special purpose financial statement. So now I have touched on the for-profit entities. It's also quite a number of accounting standard that's going to be effective for the first time for June 2020 year end. So in addition to the new leasing standard, the same as the for-profit entity, the new revenue standard and the new income standard is going to be effective for the first time. So the new revenue standard, before you apply anything, a non-for-profit entity need to ask themselves two questions. For this particular contract, a lot of times the funding contracts, is this enforceable contract with a customer? And within the contract, for whatever obligation I need to fulfill, are they sufficiently specific? If both of the question, the answer is yes, you will then apply AASB 15 to recognize revenue based on the 5 steps approach. If it's not, if any of the question is no, you are then going to apply the new income standard under the non-for-profit. So the takeaway is it's good time to start looking at your funding agreement to see which accounting standard to apply. So similar to the for-profit entities, the new leasing standard coming into effect this year. In addition to the AASB 16, for not-for-profit entity, there's 2 more standards being introduced, primarily to guide you how do you account for concessional leases. Very commonly, it's being referred as peppercorn leases. That means you are renting some places at significantly below the market terms. And the accounting standard give you the option to account the right of use assets either at fair value or at cost. So now I have talked about the update in the new accounting standard. Let me just give you a very quick snapshot on what are the other things going to be effective. The most notable one is the hybrid mismatch rules in relation to tax is going to be effective for the first time for junior and entities. So if you are a company that has borrowings from related parties who may based in Singapore or Hong Kong or other country that has a tax rate lower than Australia, this particular rules is going to be applicable to you. Thank you. Now I hand over to Renee to bring you through the removal of the special purpose financial reporting.
Thank you, Jimmy. As Jimmy said, I'll be going through the removal of special purpose financial reporting in Australia. So, first of all, why? Why are we removing special purpose reporting in Australia? Why fix something that wasn't broken, or was it? Well, this all started when the International Accounting Standards Board issued a revised conceptual framework, which forms the underlying basis of all accounting standards. And of course, we adopt the International Accounting Standards Board amendments in Australia as well to comply with IFRS. And so in the revised conceptual framework, they included a definition of a reporting entity. Now, previously in Australia, our definition of a reporting entity was based on whether you can reasonably expect there to be users of the accounts who depends on general purpose financial statements. It's quite a high level of judgment in there. In the revised conceptual framework, a reporting entity is now defined as pretty much anyone who is required to prepare accounts or anyone that chooses to prepare accounts. So basically all accounts are now general purpose accounts. So this meant, and just to run you through the applicable dates, the revised conceptual framework will be mandatory from 1 January 2020. So that'll apply to our listed companies and other companies in Australia that states compliance with IFRS. But for Australian entities that don't comply with IFRS, that complies with Australian equivalents, the amended application date was 1 July 2021. So that means for 30 June 2022 or 31 December 2022, that'll be the date that we will all have to be preparing general purpose accounts. So as a result of this, the AASB has issued amendments to the Australian 2 tiers of financial reporting. So just as a little reminder what our 2 tiers are, we've got our tier 1 accounts, and that's full general purpose accounts. And those accounts comply with all the recognition, measurement and disclosures of full IFRSs. Other entities that are tier 1 entities in Australia are for-profit private sector companies with public accountability. And public accountability is defined as companies with debt or equity that's publicly traded, managed investment schemes, superannuation plans regulated by APRA, and deposit-taking institutions. And then also federal, state or territory and local governments are Tier 1 entities in Australia. Tier 2 entities who will now have to apply simplified disclosures, which I will call SDR from here on because it's easier to say. So Tier 2 SDR reporters in Australia will be for-profit private sector entities without public accountability, regardless of the size of the entity, nor not-for-profit entities, private sector and other public sector entities. And when when SDR applies, it'll replace our current RDR framework. So that's 30 June 2022 onwards. So this will remove the option for many entities that currently prepare special purpose accounts to do that. Early adoption is permitted. So if you early adopt, that is for 30 June 2020, you can adopt it now if you want to, if you're a special purpose preparer, or 30 June 2021 is also early adopting, then you get some reliefs from your restatement of comparatives. So for example, if you've previously prepared just standalone entity accounts for your parent company, but under SCR you will have to consolidate your group, you can actually, if you early adopt the standard, you can actually have your current year numbers consolidated with your comparatives, just the standalone numbers. But if you don't early adopt, then you have to also restate your comparatives. And from 1 July 2021, SAC 1 will no longer apply. So that'll remove the judgment in whether or not you are a reporting entity. So what is SDR? That's the big question. That's a new standard that was issued by the AASB. And it's got a long name, which I'm not going to read to you, but it's on your screen. So SDR was based on IFRS for SMEs, but the disclosures only. So in Australia, there's long been a debate about whether or not we should adopt IFRS for SMEs for our Tier 2 reporting. But because there are some recognition and measurement differences between IFRS for SMEs and full IFRS, it's long been the view that in Australia we prefer, especially this is the view of ASIC and all the other regulators and so on, we prefer for our recognition and measurement to be consistent with full IFRS and our disclosures to be up to us how we see that's best done. So when we now revised our Tier 2 reporting, we used IFRS for SMEs as a starting point and then made just a few amendments, the AASB did. They actually tried to minimise the amount of amendments that they would make to that to keep it as true to the IFRS for SMEs as possible. So what does that actually mean in practice? It means that we would expect more disclosures than special purpose, but it is slightly less than RDR. So most companies that previously prepared RDR accounts might actually find themselves now having some disclosure savings. It also means we have a consistent framework in Australia with less judgment regarding what you need to disclose. And the RDR Tier 2 reports were shaded areas included in each of the standards. So you had to do quite a lot of work to find out what you needed to disclose if you have a set of RDR accounts. With SDR, you have one standard. So it's much easier for reference to tick through that one standard, what you need to disclose. So the biggest change we're going to expect in Australia will be around consolidation. So a lot of companies that previously only prepared special purpose accounts would have chosen to only lodge standalone accounts for their parent company, for example. Under SDR, that will no longer be an option, and those accounts will need to be consolidated going forward. So who is in the scope? So for this purpose, because this diagram is already a little bit full on, I've not taken public sector entities into account. And also green means yes, red means no. So I'm going to talk you through this diagram. Did I say green means yes, red means no, right? So if you're a for-profit private sector entity, step one is, do I have public accountability? If I do, then I have to continue to apply Tier 1 general purpose financial reporting. If I don't have public accountability, now I need to consider, do I lodge accounts with ASIC, or am I required by any federal or state government to prepare accounts in accordance with accounting standards? If I am, then I need to apply STR accounts. Of course, you can always choose to do full general purpose accounts if you are, a glutton for punishment. But if you're not legally required to prepare accounts by law or to lodge your accounts with ASIC, you may only be required by the company's constitution or a shareholder agreement or a loan agreement with your financier, or etc., to prepare accounts. But if those accounts are required to be prepared in accordance with accounting standards or Australian accounting standards, then they would still need to be Tier 2 STR accounts. The only companies that are not in scope would be a trust, for example, with a constituting document, constitution, for example, that's created before the 1st of July 2021. I'm going to go into trusts a little bit more in a second. But pretty much, if you are stating in your accounts that they are prepared under accounting standards or under Australian accounting standards, they would need to be SDR. So for trusts, the AASB included this grandfathering concept. I assume, or from my discussions with them actually at the time, this was because it seemed completely pointless to ask a trust to prepare general purpose accounts, but we are trying to cover all entities in Australia to have a consistent framework. So they decided to have this concept of grandfathering for trusts that were prepared before 1st of July 2021. And for trustees that's created or amended after 1 July 2021, if the trustee says you have to prepare accounts in accordance with accounting standards or Australian accounting standards, that would have to be SDR. But you can incorporate your own definition of what accounts look like if you're creating your own trust deed. So that's the thinking behind that. So if you don't want to prepare SDR and you're creating a new trust deed, you should think about putting a definition of your accounts, what you want it to look like in there. We have some concerns around corporate trustees that control a trust, whether they might qualify as a large company on consolidation. So look out for that one. And of course, any group that's structured as an investment entity would not have any consolidation requirements. So I just want to also tag on to the end of this that from 30 June this year, we have revised large entity thresholds. So in Australia now, a large proprietary company will be double the thresholds from a year ago. So over 50 million of consolidated revenue, 25 million of gross assets, and over 100 employees. The reason why this is relevant is because when Treasury issued these revised thresholds, they did say that this is supposed to indicate economic significance. Now, the wording economic significance was not written into the legislation. So it doesn't say you are of economic significance if you are now a large proprietary company. However, directors do need to consider economic significance when under SAC 1 when determining whether they are a reporting entity. So I would just recommend for anyone that still considers themselves to be a non-reporting entity under the revised thresholds, if they're still large, to just redo that assessment and make sure you still consider yourself to be a non-reporting entity. I'm going to hand over to my colleague, Callum Murray, to go through some of the financial reporting impacts of COVID-19. But if you've not yet answered the poll question or questions, please feel free to do so. We still have a few minutes left, and hopefully we can run you through some of the results of that at the end. Thank you.
Thank you, Vinay. Good afternoon, everyone. As Vinay mentioned, if you haven't answered the polling questions yet, it'd be really good to get your insight. Currently, the leases questions is quite an even spread across the board, which is quite interesting. And on the financial reporting impact of COVID-19, the key area is going concern and cash flow concerns, which people consider to be the key area to consider. So in terms of the financial reporting impact of COVID-19, we'll be looking at the 5 following areas: valuation of assets, uncertain outcomes, which is associated with uncertainty of financial reporting of COVID-19, corporate structure and restructuring, going concern, which is quite rightly a key area of concern for many people, and subsequent events as well. So in relation to valuation of assets, there's 3 areas which we'll discuss. The first being the impairment of tangible and intangible assets, including goodwill. So for impairment, there are 2 aspects to it. The first is that if you have an asset with an indefinite economic life, then it needs to be tested for impairment every year. All other assets need to be reviewed for impairment indicators at every reporting period. And COVID-19 may have caused an indicator to have been triggered. For example, a disruption to the economy, a closure of business, a loss of income could trigger an impairment indicator, which would require potentially an impairment assessment. Any impairment assessment may lead to a significant adjustment to the profit and loss and the valuation of assets. Secondly, valuation of inventories. Inventories are required to be valued at a lower cost of net realizable value. Costs could have changed due to disruption in supply, extra import costs, whereas net realizable value could have changed for a fall in demand. If we can no longer sell the good for what we could have done previously, it may result in a net realizable value falling below cost. And if we've accounted for it at cost previously, it could lead to an impairment of inventory. Also, something to consider is if you have inventory which is perishable or based on trends, just consider whether or not a provision for obsolescence may be required. Finally, on valuation of assets is expected credit losses. So under AASB 9, we've moved from an incurred loss model to an expected credit loss model. The key differential between the two is we've now moved to not just historic data, but also forward-looking data as well. COVID-19 has potentially caused a significant impact and resulted in forecasting downwards of the economic environment in the future. Because of this, debt collectability may no longer be considered as good as it was last year, and therefore the ECL models may need to be revisited in light of any economic downturn that COVID-19 may present if customers can no longer potentially repay debts or have had a downturn in business. Relating to the uncertainty, there's a number of areas listed here of potentially expected areas that may be impacted. Obviously, not all will be relevant to every business. The first is significant estimates and judgments, which all financial statements will have some element of significant estimates and judgments. And the key thing here is this just may need to be revisited and reassessed in light of COVID-19 as to whether these needs amending. The second point is onerous contracts. Many businesses do have contracts. If the contract is no longer economically viable or can no longer be fulfilled, then this contract may need to have an onerous contract provision against it, which could impact the P&L as well. And in addition, lease calculations. So as Tom mentioned earlier, rent concessions are being reviewed by the AASB, and there's some accounting standard amendment which will be announced for that. So just keep an eye on this area, but lease concessions will need to be considered as to how they're built into the lease calculations as well. In terms of revenue, there's 2 areas which need to be considered, potentially be considered as a result of COVID-19. The first is variable revenue. So this is required to be assessed at every reporting period. If the current reporting period is different to last year, i.e. we're not expecting to get as much revenue as we did previously, then this will need to be reassessed and adjusted down. In addition, contract modification can be quite complicated and contracts may be modified as a result of COVID-19 through either a change in payment terms or potentially a change in scope as well. This contract modification, as I've mentioned, is quite complicated. So each contract will need to be considered on a case-by-case basis as to the impact of the contract modification on the financial report. If the business has hedge accounting, especially cash flow hedges, then COVID-19 could significantly impact this as well. Cash flow hedges are against forecasted highly probable transactions. If the forecasted transaction is no longer considered to be highly probable in the current environment, then this could potentially lead to a derecognition of the hedge accounting and potentially significant impact to the profit and loss. Any government assistance that's received, any JobKeeper, business loans, any other government assistance will need to be considered carefully against the terms and conditions that are attached to those. It may fall under a number of different accounting standards. It's may just not fall under the government grant standard. So as I've mentioned, just consider these carefully when looking at how to account for these. If you have any insurance payouts due to any pandemic insurance or any other insurance you may have, this can only be recognized when it's virtually certain. If it's not virtually certain, then it falls into the contingent asset consideration, i.e. should we recognize it on the balance sheet? Should we disclose it? Or alternatively, should it just not be included in the financial report at all? Which will require a bit of assessment as to how that should be accounted for. Finally, from the uncertainty perspective, is taxation, and there's 2 areas to consider for taxation. The first is the deferred tax asset recoverability. So you can only recognise the deferred tax assets from losses if you're expected to recover them from future taxable profits. With COVID-19, there could be a potential change in the forecast of businesses, so therefore it needs to be reassessed as to whether the full amount can be recovered from future taxable profits. And if it's not forecasted to, it could result in a partial or full derecognition of the deferred tax asset. Finally, from a taxation perspective, is the uncertain tax positions, which Jimmy mentioned earlier. If there's any uncertain tax positions because of any ambiguity in tax relief, this will need to be built into the valuation of any accounting entry relating to these positions. From a corporate and restructuring perspective, there's a couple of areas listed on the next slide. Redundancy provisions may become prevalent going forward if the economy is to have a downturn and if JobKeeper is reduced at some point in the future. So these need to be considered as to what the value of the redundancy provision should be, but also be careful as there can be a time lag between when the redundancy provision is decided and when it's announced to people. Any performance-based remuneration or earn-out provisions would need to be assessed as well, because COVID-19 could have had an impact on these. And finally, any discontinued operations. So if a part of business was closed or there's any other discontinued operation, this will need to be disclosed separately, and it could result in a different look and feel to the financial statements that's happened previously. Going concern, which was obviously the key area raised by the poll earlier, and what I've mentioned previously in all the other slides could impact upon loan covenants, which is obviously a key area. So many businesses do have loans, and a lot of those loans have loan covenants attached to them. So if we had make any adjustments previously to do with asset valuations, any provisions, anything that may affect profitability or any covenant, we will need to consider whether or not we have breached any loan covenants and potentially any future breaches as well. This falls into the fact of a going concern assessment. So it's the director's responsibility to assess the going concern status of business. And directors, with the help of management, we need to monitor closely and reforecast regularly what the business is expected to do. From a financial reporting perspective, there's two areas which could be affected by going concern. The first is that the directors determine the business is no longer a going concern, and the financial statement should be shown on a breakup basis, i.e. all assets and liabilities should be shown as current. The second element of it is, if the directors determine that the entity is a going concern, there may be a material uncertainty on going concern that would require disclosure. So this could be anything in relation to unknown reductions in demand, when borders are going to reopen, or anything to do with COVID-19, which could give a material uncertainty to going concern. Subsequent events would also need to be considered as a result of COVID-19 due to the amount of information that's coming out day by day. So the requirement is to evaluate all information that becomes available after the reporting date, but before the issuance of financial statements. So there's two elements to subsequent events. There's any adjusting events, which reflect any event and conditions that existed before the reporting period. So it could give an indicator to an impairment indicator, for example, and then a impairment assessment could be required. And also any non-adjusting subsequent events. So if these are material, expect to be disclosed the nature of the event and the estimate of the financial impact, if it's possible. A lot of 31 December group reporters have disclosed COVID-19 as a non-adjusting subsequent event. So just to recap all of that quickly, the first part is just to consider if COVID-19 has triggered an impairment indicator and if it has performed an impairment assessment, reassess any ECL models with consideration for COVID-19, review any contracts, sales contracts, insurance contracts, lease contracts, and any associated terms and conditions in light of COVID-19, and perform ongoing frequent assessments of going concern and consider any potential subsequent events. Thanks for your time. I'll pass back to Bessie now to wrap up.
Thanks, Callum. Everyone, please follow us on LinkedIn for our latest updates and events. We've had quite a few questions coming through, and most of them have been responded online. But Tom, do you want to talk about the result of the polling question in relation to leases? I can see the answer is really diverse and interesting. Well, we have like 1 minute, please.
Yeah, look, I think 20% responded that, you know, we're prepared, confident in our approach. So that's 1 out of 5. That's probably a pretty good rate. I don't think I've reviewed too many of my clients' leasing calculations where there wasn't some tweaks required. And then in terms of the other answers, it's pretty broad response. So 23% have issues with the discount rate. 20% just find it challenging to determine whether whether they have a lease and whether they need to recognise their ROU. And then the calculations themselves, which can be quite difficult. So I think a really broad spread of answers.
Thank you, Tom. I can see some interesting comments about this new standard, and personally, I would have to agree with them. It looks like we're out of time, so that brings us to a close. And we'd like to hear from you if you have any further questions, and we also value your feedback on the session. So please complete our feedback survey, which will pop up really shortly. Thank you for joining us. Be well, stay healthy, and see you soon. Bye-bye.